What's going on, you guys? My name is Zach Hartley, and in this video we are going to talk about SPACs. What are they? How do they work? And what do you need to know as an investor? Here we go. Okay, so SPAC stands for Special Purpose Acquisition Company, and the reason that they're so popular right now and you've heard about them so much is because in 2020 they did extremely well with some really big name companies. Just to name a few is DraftKings, Virgin Galactic, ChargePoint, Workhorse Group, and even Fisker, the dead electric car company from years back, had a resurgence through the form of a SPAC. It's up over 50% this year. ChargePoint's up over 400%, DraftKings up over 300%, and 2020 was an extremely good year for a lot of different SPACs. On the other hand, a couple of them didn't do so well, but we're going to dive into that real quick. Now, how did they get started? Well, it's really simple. Somebody goes out and they start up a shell corporation. It has no operations and it has no assets, and then they take that company through a specific IPO process that kind of accelerates the IPO process, and it doesn't cost them a whole lot. So what's really nice then is you now have a company that has raised some money through an IPO process. It didn't take a long time and it didn't cost a whole lot to go to that process. Now you've got some money, and the idea here is that they're going to go out and they're going to invest that money. The advantage here is that it's so much cheaper than if you are Airbnb, for instance, and you go through the IPO process. It takes months to do the filings, it takes millions with the bankers, and it takes a big kind of process and a roadshow to get everybody excited about the stock. The SPAC is the exact opposite. It is quick, it is cheap, and you don't have to go get everybody excited about it. You just have to raise a little bit of money to get yourself started. Now, once they are started, what do? Well, it's really simple. They go out and they find private companies to invest in, and the advantage here is that otherwise you wouldn't be able to invest in that company. Now, if they aren't able to find a deal and close that deal and actually invest that money, they are obligated to return that money to the investors, usually in under a 2-year period. Now, the unique thing about SPACs and investing in them is that it gives investors access to companies that would otherwise be private at the time. Now, the risk here is when you give the SPAC your money, you don't exactly know which company they're going to invest in. So if you invest into an IPO of a SPAC, you don't know what deal they're going to end up closing. They have to close a deal within 2 years, but you don't exactly know what company they're going to choose. You maybe have an idea of the industry or what the goal of it is, but you don't know exactly which company it will be. These companies are also usually younger and a little bit more volatile because they're growing extremely fast. So you need to be well aware of that these aren't blue chip companies. You're probably not going to get a dividend. These are high growth companies that otherwise would be private, and through the process of a SPAC are going public. Now, if you're interested in learning more about this and how to read the charts and the financials, definitely check out my stock market course. It is hosted on Skillshare, and you get 2 weeks completely free when you sign up for the trial using the link down below. There's over 9 hours of content, so if you can do the whole course in under 2 weeks, you get the whole thing completely free, and then you cancel your subscription. There's over 1,100 students. There's over 60 reviews for you to read, and I promise it will be the best free resource that you can find online. Now, why would a company want to go through the process of taking an investment from a SPAC? Well, number one is that if they know they're going to go public eventually, this could be a really easy, streamlined, cost-efficient way to do it a little bit early on. There's less regulatory hurdles than a traditional IPO, and it's way faster to do, which means you can raise that money a little bit quicker and you can start to spend it a little bit quicker and generate a return. So if you're really confident in your business, this could be a great opportunity. There's also much less public scrutiny. We all remember the disaster that was WeWork and how that completely unfolded, basically by public investors looking at the documents and saying something looks a little fishy here. When you go through a SPAC, basically that doesn't happen. So there's a lot less regulatory hurdles, there's a lot less scrutiny, and it goes a lot faster. And so all of those increase the risk with a SPAC, but they also increase the ability for young, fast-growing companies to access capital markets, which is the big advantage of a SPAC. Now, what happens after they make that investment? Well, there's a couple of different things. Number one is now you can buy the SPAC and you know exactly what they're going to invest in, which is nice. And usually that SPAC will then change its name and its ticker to match the company that it has invested in. So for instance, ChargePoint, the electric vehicle charging company, was bought by a SPAC called Switchback Energy. At some point, we expect them to change their name and their ticker back to ChargePoint to better reflect the stock that you will be buying. So those are some of the things that happen after the investment is made. Now, a couple of numbers just to give you some reference. In 2015, there's about 25 SPACs that IPO'd that year. In 2019, there's about 95, and in the first 10 months of 2020, there was 165 SPACs that IPO'd. So the number of SPACs hitting the market is exponentially growing. This is becoming a very popular investment method. However, the history of SPACs and the historical return hasn't been very good. There's definitely a lot of companies that have hit it out of the park this year, but there's not a 20 or 30 year track record that you can look at like there is in the Dow Jones or the NASDAQ or the the S&P. So you need to be well aware of that. Now, sometimes these SPACs can also be called blank check companies. The reason that they're referred to as blank check companies is because when somebody invests into them, they don't know who that SPAC is going to invest in. They don't know what deal they're going to get. And so they might be investing into a SPAC, buying it at $10 per share. But what they're really doing is they're investing into the management team of that SPAC to go out and find a private company that is going to meet the agenda and hit the requirements that they're looking for and actually turn into a valuable investment. So when somebody says that this is a blank check company or it's a SPAC or anything like that, what they're referring to is that you are giving your money, $10 per share or whatever it may be, to somebody to invest into a private company and hopefully get you a return, almost like a venture capital, almost like a hedge fund. So you need to be well aware of what you're investing in and what stage that SPAC is at. Are you getting in on the IPO? Are you getting in when they're trying to find the company? Are you getting in when they're closing the deal? Or are you getting in after the IPO and they've already gone through the SPAC process, such as Nikola? Nikola was a company that went through the SPAC process and is now listed as Nikola. It is named as Nikola, but it was bought and originally acquired by a SPAC. Now, one last note here is that the management team and the people going out and making those deals are usually referred to as the sponsors of the SPAC. And yes, they usually do get a very, very good cut of all of the money and all of the gains in that SPAC. So you need to be well aware of what they're going to be making and what they'll be taking from the deal, as well as what the deal is. If you're investing into a SPAC and you know that Switchback Energy is buying ChargePoint, you need to go look at the presentation. You need to go read the documents. You need to make sure you are well aware of what you're doing and make sure that you do the due diligence. There's nothing wrong with buying a SPAC. It's almost like buying a stock. However, there's a little bit more risk because it can be harder to find the information, or sometimes that information just isn't available yet. And so you need to make sure that you know what you are buying. Now, if you're interested in seeing any of the SPACs that I am in or that I am buying, you should definitely consider signing up for my Discord chat. That is where I'm trying to build a community of traders where I share my watch list, I share my technical analysis, and I try to get everybody else to do the same so that we can generate more trade ideas and share our research. If you're interested in anything like that, it is $5 per month and I would love to have you there. The link is down in the description below. But in summary for this video, SPACs make it easier for young private companies to go public. There's less regulations, it costs less, and it's a faster process. However, SPACs are harder for investors to evaluate and therefore they have higher risk. You don't always know what company you're investing in. You don't always know what the financials look like, and it can be much, much harder to pull that information. However, if you're interested in seeing any of the upcoming SPACs or any of the recent SPACs, there is a link called www.spacinsider.com. I found that they're an excellent resource. This video isn't sponsored by them. I don't have an affiliate link, but definitely check it out. I found that that was a decent resource, but just Google it. There's a lot of information coming out about SPACs, and it's a complicated subject if you're not sure how to trade the market in the first place. And if that's the case, then definitely sign up for my Skillshare course. But if you get any value out of this video, please consider hitting that like and subscribe button. I sincerely appreciate it, and we will see you guys tomorrow. Good luck trading, good luck investing. See you soon.